Welcome to Finance Essentials. Now, the purpose of this workshop is to help understand the basics of understanding money, cash coming in, cash going out, understanding key ratios related to the business and how cash can be beneficial, how to best manage cash is what Financial Essentials is all about. Now, for some, this may be pretty basic. But the idea of our work at Project 500 is to really help businesses scale. And part of scaling is being able to effectively manage resources so that you are maximizing revenue and minimizing expenses. And obviously that is done in part based on your desires, your mentality, the culture of the company, and the strategy and the business plan that you have written. And so there are lifestyle businesses, which are wonderful, and therefore revenue oftentimes exceeds expenses, but it's in a way that allows for one or two individuals to do well and be successful. When you really think about growth, your revenues are definitely exceeding expenses, and you're actually targeting to make anywhere between 10 to 20% profit per year, as opposed to maybe 1 to 5% if it was a lifestyle business. When you're really talking about scalability, then you're talking about consistent year-over-year growth and year-over-year profitability of anywhere between 30 to 50 to even 100% in some cases. But the only way that you can determine if your company is lifestyle or growth versus scalability is not just in what you say, but how you're managing your finances and what your financial statements say about you and your business. So I know there are a lot of people, having been a finance major myself, that say, I hate numbers. But the reality is 2 plus 2 is always 4. And the goal in growing your business is to get as many zeros as you can behind that front number, because that then begins to show your economic value. The importance of understanding your finance essentials is that money demonstrates how well the business is going. Your financial statements articulate the value of the business, and your budgets show the values of the business. So your financial statements show the value, the economic value, but your budgets and how you spend money demonstrates the values of the company. Do you value salaries over equipment? Do you value insourcing and hiring employees versus outsourcing? So really understanding your numbers are important because they tell a story about you, and you want to make sure it's the story that you want to be told about you. So the idea around doing your financials, part of it is really creating a framework and understanding what is it, what type of growth do you want your company to achieve? The second thing is thinking through, what does that mean? What does that mean in terms of generating revenue? What does that mean in terms of scalability? Then understanding what kind of money do you have to spend? How much of that is going to be cash that you have? How much of that may be debt that you have to get from somewhere else? And understanding the values that you're making when you budget. For example, are you using contract employees versus full-time employees? Contract employees have tremendous benefits. There are variable costs because the amount that you pay them will change. They minimize your overhead because they don't have benefits. But the downside is they don't work for you all the time. And so when you make that decision to an outsider, it may say, oh, well, you're being frugal and hiring contract folks. But at the same time, if you're really trying to grow a company, it says, well, when do you hire them? Because someone being hired means they have a loyalty and level of engagement in the business that will ultimately reduce your employee turnover costs. So really thinking about that. And then understanding the statements so that when they are shared with other people, it is articulating what you're saying about when you make money, when you break even, and how you're managing your cash flow. So part of understanding finance essentials is being able to do your own financial forecasting by leveraging a variety of statements. The biggest statements for you to be aware of are income statements, which demonstrate revenue versus expenses, your balance sheet, which talks about the assets you have versus the liabilities and also clearly demonstrates owner's equity, and then cash flow in terms of how fast and how much money is coming in and how and when is it going out the door, to demonstrate at any point in time what is the cash position of your company. The others are, if you're using or seeking investment, there's something called use of funds, where you demonstrate what it's for. If it's for hiring staff, it's for equipment, it's for R&D, it's for intellectual property. Your cash flow runway is really a projection of cash flows to really think about when will you need an infusion of cash, how much can you make over time, and how long, if you all of a sudden something bad happens in the market or to your business, how long can you exist on the cash flow that you have. And a capital formation table is literally a table that demonstrates how much capital is allocated to each of the owners. So when we think about the statements, again, there's only three: income statement, balance sheet, and cash flow. And as I said, an income statement is your revenue minus expenses. That's oversimplified. But it really talks about over time. So typically they're done on a quarterly basis or an annual basis. So it is the culmination and summation of how your business has performed over a period of time. Your balance sheet is literally a comparison of your assets versus liabilities and shows equity. And again, that is in a period of time. There is a specific date that is done because it may change date to date, day to day, year to year, month to month. And then your cash flows are literally how money is coming in and what is the timing of the expenses in terms of how it's going out the door. So your income statement is typically 1 to 3 years. So it would be 2016, 2017, 2018. Your balance sheet is as of a certain date, typically done on a quarterly basis. So as of Q3 2017. And your cash flow analysis is typically on a monthly basis. So January, February, March, all the way through December. So we talk about the three statements. And so the income statement talks about whether you're profitable and you're making money or you're not. The balance sheet talks about how healthy, what is the condition of the business, and your cash flow talks about how and demonstrates in what way you are managing your resources. Now, financial statements are important because they're not just used by you to really help inform business decision, understand where to put money, where to divest, where things are going well, but it's also something that demonstrates to your employees, and certainly if you take on investors, whether they're bankers or angel investors, begins to demonstrate how healthy the business is. And so it is a standard document that people will ask for to really see how well the business is doing. It's one thing for you to say, hey, we're doing great. It's another thing to be able to demonstrate it. So the income statement is something that actually tells me how is the business doing over time. And here's what a sample income statement looks like. Year over year, revenues, if you have multiple products or multiple service lines, cost of sales or cost of goods sold, gross profit, and then all of your expenses. And if you're lucky, you're seeing net profits at the end. Your balance sheet is made of assets, all those things that bring value to the business, liabilities, all those things you owe, and net worth or owner's equity, how much equity, just like in your house, is in the business. And the idea here is that you're showing a relationship between those so that in the event something needs to happen, you understand, is there value in the company that can be taken out? Where are liabilities being expended? And in this case, how many of them are current and how many of them are owed? Because you will have things called receivables. And so you can have salaries receivable, which means that there are salaries that still need to be paid, or accounts receivable, which means that there's money still owed to you. The balance sheet demonstrates, again, the full health of the organization, because if you're over leveraged or you're waiting for money to come in than your expenses, then that could be a problem and signal a challenge. So it's important to know these statements are not used separately, but they're looked at in a collective manner to really understand what's going on in the business. And here's a sample balance sheet. This is done on an annual basis. Typically, they're done on a quarterly basis, just so you can see what's happening. And you see all the assets and then liabilities, and then retained earnings is where the equity would be in the company. And the cash flow statements are the last ones, and again, tells you how cash is coming in and going out, but more importantly, helps you make decisions on a regular basis. Do you have the cash in the bank? Do you need to use credit? Are you over leveraged? Are your credit payments too high? Are you waiting for money to come in? So it's a great way just to see on a specific date how the business is doing. And so it's cash in and literally cash out. And here's a sample cash flow statement. Looks somewhat like an income statement, but you can see that it's really around accounts receivable, prepaid expenses, if there's financing activity. So it's important to get comfortable with these three statements: income statement, balance sheet, cash flow statement. And certainly the cash flow, again, helps people understand how you're doing. Balance sheet, health of the organization. Income statement, is the organization profitable or not? So I'm going to leave these exercises in here because it's important that you not just understand what the statements do, but you understand how they actually work. So when we think about net income and you have sales and cost of goods sold and gross profit less operating expenses, it's important to know what these things are, because even if you're not in the product business, which is cost of goods sold, you still may have cost of sales in terms of your marketing costs, etc. So when you look at these numbers, I want you to go back and fill it in. But for now, we know that you want to be able to figure out what it is in terms of how do you calculate net income. I want you to figure out how do you do cash flow in a worksheet and those kind of things. But so for the worksheet in terms of cash flow, you have all of these activities: purchase of new equipment, that's an outflow; new loan, that's an inflow; sales, that's an inflow; money to investors, out; utilities, out; salaries, out; increase in inventory, in; decrease in accounts payable, out, right? Because payable means you owe. And so when you begin to think, where are they? Then you begin to see that's indeed where it is, right? Money going out versus money coming in. And in this case, it shows that you have a positive cash flow. So it's important that you spend time practicing. So I left one exercise for you and showed you how it works, but constantly just understanding both the lingo and terminology, but more importantly, what are the underlying decisions and what are the underlying assumptions that I'm going to make. If you're working in the business, it's going to help drive business decisions. If you're looking for an investor or a lender, then they're going to use this information to determine how much you're eligible for and what your interest rate. Government looks at these to determine your tax liabilities. This makes it a whole lot easier to fill out your tax statements. Vendors are going to see what kind of terms they're going to give you based on your cash flow. It's very rare that customers may see this unless you're dealing with large B2B, business-to-business contracts. And then, of course, employees, may say, I want to see the overall books because they want to make sure that, heck, I'm actually going to get paid. I know that I'm going to be able to get paid. And so it's important that in order to develop these statements, you have a set of internal systems and processes that allows you to regularly calculate this. Now, if you're lucky enough, you may have an accountant who does that, and I highly recommend that. But even when you outsource this activity, you still have to fundamentally understand how it's done and what the statements stand for. Because when you go to a meeting, the accountant's not going for you. So you do have to know this information. You hear the stories all the time with celebrities and athletes who had lots of money, and all of a sudden it was gone. You have to be able to understand how to manage your own money. So it's important to keep track and have a system for receipts, invoices, bank statements. Some of you may be using QuickBooks, some of you using some other system, but the more you can automate this, then the easier it becomes to be able to develop these statements. So as I said, you're going to need all three. And so they're linked because they begin to really tell what's going on in the business. The balance sheet and the income statement really talked about how profitable the business is, and is there any retained earnings available to show that the business is growing and the owners are actually making money. For income statement and cash flow, it talks about, is there money left over to carry over if you have a cyclical business or a seasonal business. Cash flow is extremely important because you may not have all the cash you need at the right time, but if you're setting it aside, then you may actually be in a better position to cover those months where your outflows are greater than your inflows. And then certainly the balance sheet and the cash flow begins to see that if money's coming in, are you able to save it and keep it and put it in equity? Or are you required to continue to spend, or are you having increasing payables? And so again, it's a way to really talk about the overall health and success of the business. And this is just more on balance sheets. So what's in there: sample assets, cash, accounts receivable, prepaid expenses because you've gained value by paying in advance, long-term assets, tangible, fixed things like property, plant, and equipment. For liabilities, accounts payable, what you owe, accrued expenses that haven't been paid. Obviously, taxes are always a liability. Long-term liabilities, typically more than a year. So if you have any investments or term loans or mortgages, that's going to be important. And so when you think about what is key about each of these, right, and how people will know what's happening, this is just another way to see how the statements really work together. For cash flow, you're really looking for net profit and depreciation, which is found in the income statement. You're looking at the change in the value of the business, which is the balance sheet. So again, I cannot reinforce enough the need for you to become comfortable with these statements, because this is really just the beginning. And again, highly recommend any online automated financial accounting system that allows you to input information automatically and do it in a timely manner so that you're not missing something. Sometimes your banks will have various systems. They may be able to scan things right into that. But the more that you can stay on top of and create internal systems that every time a check is written, that there's a duplicate already there, or that it's scanned into a QuickBooks or some type of application, or somebody codes it automatically, it allows these statements to be kept up to date, because you just never know when you're going to need to know what is the current position of your business. So when you have these statements, right, then part of it is not just where you are now, but where are you going to get to? How can last month, last quarter, or last year's financial statements help determine what the future is going to look like? So statements are important in your current position, in your historical position, because they tell you exactly where you are and how you spend things. But these sheets, these income statements, cash flow, balance sheet, are the foundation for your ability to be able to project how well the business is going to go. And that is important as a manager and an owner and a CEO and an entrepreneur, because the history will help you determine the future, because you'll have data by which to make decisions. And so financial statements are, again, not just used to show historical performance and give confidence to individuals who may be trying to invest in you, but then they're going to say, well, what is the financial forecast? What does the future look like? Back in the day, we would calculate out 5 years, but that's too far. No one knows what's going to happen in 5 years. So typically you want to go 2 to 3 years out, but using these statements as a way to say, here's where I think my company is going. And it helps to answer questions on, how am I doing? How am I growing? How fast am I growing? Can I afford to make an investment in my growth? And it helps you determine, are you confident that you can self-finance because you have equity to grow your business? Or will you be seeking other people's money to be able to grow your business? So I'm going to take an example of how you actually would create your own future revenue model. So you'd look at historically, right, that you know you have some general revenue, and one easy way out is say, well, I'm going to assume that I'll grow 1 to 2% every year. Well, that's a very bottom-down approach. You're taking historical sales and assuming they're going to continue at some growth rate, but it doesn't help you provide the level of accuracy around your expenses. So it's important, as you're thinking about developing your budgets, that you look at what you're selling. So this is assuming that Fishbone, which is a group way back in the day, that how they actually develop their revenue. So they know that they have 3 ways they make money, right? They sell tickets at concerts, they have people who buy merchandise, and they sell music. This is really old because it talks about albums. So they know that those are the 3 ways. So what are your ways? How do you make money? Is it contracts? Is it products? Is it services? But really determining what are those, and then what is the metric that shows success? So for tickets, revenue is generated by price of the ticket. For merchandise, they're only selling it at concerts, so it's correlated to what percentage of attendees are actually going to buy the merchandise. And for recording, it's literally what's the money made for every album sold. And then you develop models of how you predict how each line of revenue is going to scale. So you know the number of concerts you're going to have moving forward. You look back at what the average purchase or average number of attendees has been, and you can project that moving forward. So hypothetically, you may say, we're going to do 5 concerts. Our typical, our average, or our median or mean attendees has been 1,000. So we're going to expect 1,000 moving forward. Or we only did, we did 10 concerts before. Now we're doing 5. We're creating scarcity in the market. So we're going to have 1,200, and we're going to be able to charge more. But you begin to think about those assumptions and do that for each of these. And that's how you get the total revenue. Now, this may be a model that seems somewhat complicated as you go on to do your own, but it's going to be extremely important that you understand what are the key inputs of how you make money. It's also important you understand what are the key inputs of how you spend money. So if we think about, for Fishbone doing a concert, these are all the expenses, right? Cost of goods sold. And that's directly correlated to how quickly the inventory turns over. If it's sitting there, the cost of goods sold goes up. For payroll, how many people are required to be there every single time? That's probably directly correlated to how many people are in attendance. So you really need to understand, how do you drive the cost, what creates the cost that you're managing, because it's not going to be you making a decision on revenue, merchandise, recording, cost of goods sold, information technology, payroll, facilities as a whole. But when you have to make decisions to manage your business, you're going to make decisions around how many employees do I need in the store? Do I really need this much square footage? Do I need to spend that much on advertising? Am I charging the right price? So it's important that you understand the underlying costs so that you're able to then make those decisions as you move forward. And so pro forma is just a time period. It's a quarterly time period or annual time period where it's been cut off, and this reflects everything up into that date. And so you see everything that was in an income statement, everything that's in a cash flow statement. So it's important that income statement, balance sheet, cash flow, income statement, period of time, how successful the business has been in making money, balance sheet, period of time, how healthy is the business in terms of having greater worth in terms of assets than what is owed, and then cash flow, how am I doing on a daily basis, weekly basis, monthly basis, quarterly basis in terms of having cash to effectively run my business. Understanding all of those inputs allows you to create an economic forecast model moving forward to say, this is what I've done for the past 3 years. What do I think I'm going to do for the next 3 years? And starting from the bottom up. Top down is okay, but it undercuts a lot of assumptions and oversimplifies. Bottom up future forecasting means you're looking at each of those inputs, from employees to marketing expenses to square footage, and really thinking about what you can afford moving forward and what is the impact going to be on costs so they're minimal, and therefore you can maximize revenue. I know that's a lot, but it's important that you continue to master your own understanding and articulation of your business. Your financial statements articulate the value and success of your business. You can say I'm making money and I don't see it on the financial statements. It doesn't matter. So aside from the business plan, and probably aside from any contract you're going to have, the financial statements are the most important messenger of how healthy your business is. As outsiders, we want to look at these statements because it doesn't just tell us your health and your current cash position and whether you're profitable, but I take those numbers and I can actually determine other things about your business. And there are key ratios that we use around financial modeling to decide whether or not your predictions about the business are accurate. So we talked about top down, where you're just thinking about what's an average percentage increase in all my costs across the board, instead of thinking about personnel. You're thinking about what's the 1, 2 cost of living, 3, 4 increase on revenue, without thinking about all the inputs that go in. So it's important that you really determine and spend the time, I would say, on a bottoms up approach as opposed to a top down. But the modeling, again, not only articulates what's happening, but it helps tier up your sales plan, your hiring plan, your expenses, and your metrics. Because when you begin to understand the statements, and particularly what your cash flow statement is telling you about how sales occur, when they occur, are there cycles, are there seasons, that's important, because then you know when to go to market, when to pitch people, when to sell, where to sell, how much. But it also then correlates to how many people you're going to hire and all the other expenses related to that. So really owning your financial statements is important. And then this issue of metrics and understanding, again, the inputs. If you make money, that is a wonderful thing. But when I, as an outsider, as an investor, look at that number of revenue, I want to know what's in there. How many customers is that? How many of those customers are repeat customers? Is that one big contract or 10 little contracts? Because all of those change the perception. If it's one big contract, oh no, I'm worried. It could be $1 billion, but I'm worried, because if they go away, the business is dead. If it's 20 different contracts, I have a level of confidence because there's diversity in terms of sources. I'm even more confident if they're coming from some from universities, some from hospitals, some from the government, because there's now diversification of sources. So it's important that when anybody looks at that revenue number, you understand what got you to that number. And that's what we call, in terms of key ratios or metrics. So revenue is great, but how do you get there? So if you're someone that does business online or through some other kind of supply channel, so you have a product and it's sold in a store, or you have a product and it's sold through a sales team that is not related to your organization, we'll look at something called gross merchandise value or gross transaction value. And that means the revenue that goes to the company. So it means that it's the revenue that goes to the sales team and goes to the company. So it's not net merchandise value or net transaction value, only the money that goes to you after you've paid all of your expenses. But if you're selling something in Safeway and that store makes $1 million, then your gross merchandise value is $1 million. But if it costs you $250,000 to get it in there between sales team, transportation, and marketing, then your net merchandise value, your net transaction value is now $750,000. Gross is everything all in, net is less expenses. I look at the revenue and I say, okay, is it recurring? Does it happen over and over again? Or am I having to sell to someone every single time? We've heard this term stickiness, which means it basically sells itself. And recurring revenue is achieved if you have someone who's paying on a regular basis. So it's a product that they have to regularly replace. If it's, for example, if you're a hair salon and somebody comes in on a weekly basis, that's recurring revenue, and there's a history and evidence that it's recurring. If you're a caterer and you know you always cater a certain company's type of events, that's recurring revenue. Then there's monthly recurring revenue, meaning that it's going to come every single month. So if you think about something that's taken your credit card, like Netflix, and they deduct your money, then therefore you now know that that is monthly recurring revenue, but it also is a level of revenue that provides confidence in terms of what you're doing and your revenue projections moving forward. Then you have new monthly recurring revenue. So if you're selling something and you have people coming in, the rate at which you're able to bring new people on. So for Netflix, they maybe had 100 customers, then they had 1,000 customers. So that difference was 900 new MRR. And so you keep going, but you want to be able to distinguish who are the new people so you can look at trends and understand how you're getting new people. How are you expanding? Expanding means they've been monthly customers, but now you're able to sell them more. So if we stick with the hair salon, you're now going from wash and curl to maybe a relaxer or maybe a natural style, or you're going to locks. But something where you're beginning to sell or upgrade. If you're selling software, you're selling now maybe the customer service part that goes with that, or the maintenance part that goes with a product. You're going to lose people. And so understanding what got downgraded and what got canceled. These are questions at a level of detail that you may not have right now. And you don't actually have to have if you don't obviously have monthly recurring revenue. But it is important to understand what revenue is consistent, what is new, and what is the potential for loss over time. If you're doing in the contract business, what is the total value of the contract? Meaning, what is the total amount the client will spend with your company? So if you have a 12-month contract, is it $1 million? And more importantly, is it $1 million over 12 months, or is it tied to specific deliverables? And then the annual contract value is what they commit over a 12-month period. And this is relevant because it could be $1 million over 2 years, and therefore that's not the same as $1 million divided by 12. You cannot claim the whole value within that year unless you've actually done so. And that's where we come the difference between cash and accrual. So from an accounting perspective, you have to decide, do I count something as revenue when it's received as cash, or do I count something as revenue when it comes in, even if it's going to take place and I'm going to get paid over a period of time? And that's important because it will affect your cash position at any given moment, and you can't change. You have to pick one. So if you've been not jotting down revenue when somebody pays you, particularly if you operate on a cash basis, then great. But if you operate on contracts, and let's just say the city gives you a contract in February, right? But you're not going to start the work until December. In February, are you writing it down? Well, if you're on an accrual basis, you're claiming the full value of that contract in February, knowing full well you're not going to do the work until December. You may have been awarded the contract, but you have not received payment. If you're operating on a cash basis, then you will write that contract in December when you get your first payment, if that's as a retainer or if that's after services have been provided. But the idea is that you have to decide, do you document revenue when it comes in, which is cash, or meaning cash in hand, payment received, or do you document revenue when the promise to pay you has been initiated? It's a big decision, so I would definitely encourage you to talk to an accountant. The cash method is common in small businesses. Income is not counted until the money is actually received, and then expenses aren't counted until they're paid. I would say it's probably the more simplistic thing, so you're not dealing with payables and receivables. But for some, if you live on a contract basis and you worry and need outside money because typically your payments are 6 months thereafter, your business may not look that great if you're on a cash basis and you get all of your contracts in January, but they don't get expended till June. So it's something, again, not easy to change. Once you do it, you have to be consistent across the board with all of your statements. So it's worth spending time talking to an accountant to understand what's the best method for you. And then, of course, after you determine the inputs of revenue, what's the net, how much you've made, after expenses, what's the gross, how much you've made so far, and most importantly, what is the margins? What is the profit that you're making? And that's the percentage of total sales the company retains after deducting costs and services associated with producing the item. Understanding your margins is extremely important. And obviously, it's not just important for you, but it's also important for outside suppliers and possibly lenders. If you are to supply a large company, they want to make sure you're going to be in business long enough and have enough money to be able to actually cover the order that they've made. And so they oftentimes will ask for your statements and they'll run these. What is your gross profit margin? What is your operating profit margin? What is your return on total assets? That means it looks at how effectively are you using your assets to generate profit for the business. It is not important that you know how to calculate these. It is important to know, though, which of these is most relevant for your business. Liquidity ratios means how are you doing on cash? How much are you overextended? How much equity do you have in the business? Are you able to pay off short-term loans? The quick ratio is something anybody who's going to invest in you is concerned about. Can you meet your obligations? Can you pay your liabilities? And then leverage ratios means how well are you using your money to actually make more money? How well are you leveraging debt to actually finance the firm to create greater growth? How are you doing in terms of managing your money that's owed to debtors versus creating equity in the business? Again, you don't have to know all these, but it's important to know that people are watching you from how quickly do you pay your bills, how effectively are you using your assets, how leveraged are you, how much debt, how much equity do you have? And if you're in the product business, how effectively are your products going? Because if you develop products and they sit in a warehouse for a year, your cost of goods sold has gone up dramatically, and that's not a good sign. That means that you're paying a fixed cost, which should have been a variable cost, because the idea is that you're selling product and it's moving out the door. It's one of the reasons just-in-time manufacturing has become very popular, because there's a big cost, not just the cost of the warehouse, but the cost of housing, the cost of not being in the market. So people then, if you're in the product business, will look at these things called activity ratios in terms of inventory, but they'll also look at it in terms of how are you paying your debt. This is really about how is your money being locked up and how liquid or how much cash can you access at any given time. So we've talked about financial statements, income statement, cash flow, balance sheet, depicting where the business is right now, as well as historically. Doing a preferred bottoms-up approach, understanding the inputs to be able to create future forecasts, to be able to understand the ongoing health of the business by looking at gross margins, understanding the source of revenue, whether it's monthly or not, to then show the viability of your projections moving forward. Now, all of that is extremely important just for you. As the owner, entrepreneur, CEO, person in charge, it is extremely important that you always know the financial viability and sustainability of your business. It is part of the commitment that you make to your employees. It's part of the fiduciary responsibility you've taken onto your board. And in many times, it's part of the contractual obligations you have made to the purchasers of your products or services. These things are also extremely important if you're considering investment. Now, we're going to talk about investments when we cover fundraising, but I at least want to give a little bit of a teaser of things to think about. So first of all, you need a business plan. We've talked about business planning, but you need a plan. You need to have all of this written down, because if it's in your head, I always live by the hit by a bus rule. If I get hit by a bus, can the business continue? And on some days it can't, but that's not a good thing. So it's extremely important that you document where you see your business going. A business plan is the roadmap that's going to allow employees to trust you, investors to feel good about getting their money back, and any partners to know that you're going to be around for a long time. It also answers that question that we started with: is the lifestyle business, is this a growth business, is this a scalable business? And then if you're thinking about taking on investment, give yourself at least 12 to 18 months, because it's more than a notion. If you are going even to a bank, they may tell you we can make a decision in 6 to 9 weeks, but do you have all the paperwork required? Do you understand what goes into the underwriting process? Is all your paperwork in order? Are there any outstanding bills? Are there any outstanding liens? Are your tax records up to date? So you want to give yourself enough time. You never want money when you needed it yesterday, period. You want to think about what kind of money do you want? How long do you need it for? Are you willing to give up ownership in the business? And how risky of an investment is this? And we talked early on about one of the documents, in addition to the 3 statements, is use of funds. What are you using it for? And that's important to outside investors, whether they're banks or angel investors or venture capitalists, because they want to know if it's a bunch of fixed costs and I run the numbers and see that you're not effective on turnover, or you have a high debt to assets ratio, then I'm concerned that my money is just going to go pay old bills and not be used to generate future growth. And there's a range of investments, right? If you are in the market and you're looking for a grant, if you believe that you have something that has some social benefit, if you're willing to have equity, if you're willing to take on subordinated debt versus senior debt. Subordinated debt means that if whoever lends you that money, they're going to be last to be paid. Senior debt means whoever loans you that money, they're going to be first to be paid. There's guarantees where you may say, I'm going to get a loan, but I have to guarantee it. Oftentimes, maybe someone's home or someone's business or some asset of equal value or near value. And then if you decide to take money out of the investments you may have, you have a pension fund or you invest in the stock market, then you may be able to pull investments from fixed income, public equities, pension funds, those kind of things. But it's important that you're really clear, if you're even remotely thinking about investment, that you understand what you're in for. If you're looking to get venture capital, you really better be planning on growing a really big business. Venture capitalists are looking for big returns because they are using other people's money, and those other people are expecting significant returns. And they have to then, the venture capitalists have to produce significant returns that allow them to then generate net revenue to pay back, because there's expenses with running that firm. If you're interested in just going the debt path, then there's lots of ways. Take out straight debt. There's crowdfunding. There could be royalty financing that's tied to the revenues that you're making. Or you can do a combination where you get a friends and family around, some angels, and then you go out and get a loan. So lots of ways to think about how you're going to scale your business. But again, it takes time. Even if you're going to the local bank, if you don't have all your paperwork, you will find that it could drag on for months because you're waiting for one piece of information that you either can't find or you have to get replicated from the city or from a federal agency. So it's important that if you are thinking about investment, you get clarity on what kind. Equity investment means you're giving up ownership in the company. The beauty is, if you lose, they lose. If you win, they win. They're sharing the risk. But that risk is going to cost you. And so you have to think about, do you want somebody else involved in the company? Now, it doesn't mean the day-to-day, but it does mean you won't have 100%. However, what is the line? 100% of 100,000 is nothing, but 10% of a billion is everything. So the ownership piece is not just around the number, but what is its value? Hopefully everybody's familiar with debt financing. It's taking out a loan. There's lots of different ways. We talked about subordinated debt and senior debt, but the idea of taking out a loan. And the key here there is they're going to look at your cash flow statements and see if you can actually service the loan. Are you generating enough cash you can actually pay your monthly note? Otherwise, they're going to be concerned that they're not going to be able to give it back. And then there's royalty financing, where instead of the financing being tied to your credit score or to the cash flow of the business, it's specifically tied to the revenues that are coming in. And there's a few folks that actually specialize in royalty financing, but very sector specific as well. And then it's important to know who the investors are. So they're angels, individuals who have a certain income level, have a certain level of wealth by law, and can actually make investments. They are perceived to have capacity financially and intellectual understanding to make investments. And so they are individuals who put investments in other people's businesses. They're typically equity investments. They take an ownership. or they're convertible notes or debt instruments that convert to equity, but they're individuals, and we'll talk at another time of how you find them and how they work. And there's crowdfunding, which has become very popular. But I want to be clear, it's not free. It costs money to be able to list on these platforms. You have to go through a level of diligence. You can't just sign yourself up. Unless you're raising grant money or free money, you can't just sign yourself up. So it's important to understand how the crowdfunding platforms work. And then there are venture capitalists. People go out and raise money from other people. They typically invest a lot more than angels, but they are certainly desirous of a return, and they're taking equity. And then there are banks who typically are going to give a debt instrument. They don't care if your business is successful or not. Venture capital is in it with you, but all the bank cares about is, can you repay the note? So we've talked about statements, forecasting, understanding the inputs, and if you're thinking about getting investment. The most important thing that I can say is that Financial Essentials is understanding that your statements reflect the value and values of the company, and it's extremely important that you understand the inputs that generate the outputs that ultimately determine the outcomes of the business. If you're not making money, then your business is not going to grow. If you're making money, but how you spend it makes all the difference in the world, that's going to determine the growth of your business.